call the meeting to order, and I need a motion to waive the quorum. I need a motion and a second to waive the quorum. So moved. And I need a motion to approve the minutes from the last meeting. Motion. Second. Okay, so moved. Before we get started, I really want to say how much we appreciate the NAIC and the commissioners for participating with us. I said it really, I've said before, it's really a symbiotic relationship between legislation and regulation, and we really so appreciate this relationship, and I'm glad we've been able to strengthen that over the years. Glenn, I think you said you wanted to comment.
Oh, got it. Thank you. Thank you, Madam Chair. I did just want to, number one, thank you for this opportunity to have this exchange. I will 100% echo your comments. I think we have I have often overlooked when I come back to NCOIL, because I just think of NCOIL and I see Matt and I see Deborah and Tom, but forget some of the new people that may be here, and things have not always been has gone as well as with our two organizations as they have now. I don't think they've ever been better, and so thank you for that. That takes some work to build and work on that relationship. That's just a little bit of history, but I also just wanted to congratulate you as you wrap up your year, Representative Ferguson. So it's been a great year for NCOIL. Congratulations as you wrap up. I also want to bring apologies from Superintendent Beth Dwyer from Rhode Island and Judy French, the commissioner from this state of Ohio. They were both with us at the breakfast, but Beth has been traveling substantially in the last couple weeks, including internationally, and she was out of here, and Judy got called into a meeting with her governor, and we know how that goes. Somehow she didn't have her priorities straight, and she went and met with her governor instead of with us. But anyways, apologies for them. And also, Dean Cameron from Idaho, who typically is at the NCOIL events with me, and we have been now for years. And Dean, just a matter of a couple days ago, was asked by his governor to take over their largest state agency, the Department of Health and Welfare, on an interim basis, not permanent. He still is over the insurance department, but he has his nose deep, I think, in figuring out that budget for the next few days as they go into their legislative session. So he will be in an interim role through the end of their legislative session at the end of March. So Dean brings his apologies for not being able to be here. And so I do just, and one final thing, we have with us Commissioner Donlin, and for those of you, again, new folks don't know, he previously served in the legislature in Louisiana for 19 years. He has now served as insurance commissioner for 18 years. And we were joking at breakfast about his next stage, which will probably be 17 years, whatever that is. But he has served this world, this space, extremely well, and I've teased him multiple times in the last couple months that he's on his victory lap here as he wraps up his 18th year. But then just another general comment about NAIC and NCOIL. I do think when we come to these, and when we have our legislative folks coming to our meeting in just a matter of a couple of weeks in Orlando, and working together, working collaboratively as we have been, makes us both better. So thank you for that opportunity.
Would all of you introduce yourselves and tell what state you're from? And as I said at breakfast, I think I didn't realize till I got here that all insurance commissioners weren't appointed as ours are. So if you're elected or you're appointed.
Good morning, everyone. I'm Sharon Clark. I'm the Kentucky Department of Insurance Commissioner, and I am appointed.
Good morning, and I am Jim Donlin. I'm the Louisiana Department of Insurance Commissioner. My neighbor at the NAIC and now dear friend Sharon Clark, my former colleague and dear friend Tom Considine, and I served as fellow commissioners, and one of my forever memories was the day APCIA, now APCIA, formerly PCIA, invited us to present in their board meeting at a national meeting, and invited us to go in together, which we did. And Tom is raving about the reforms that they had imposed and implemented in New Jersey, and I'm about ready to do my story about all the great success and reforms in Louisiana when I had the thought and said, wait, stop. I need to get a mental Kodak picture of this meeting of the insurance industry with the regulators from New Jersey and Louisiana raving about the reforms we've done in our respective states.
So Glenn Mulready, Oklahoma Insurance Commissioner. I am wrapping up shortly here my 5th year, and I am elected. Again, those that may be new to this space, there are 11 of us across the country that are elected.
Hi, I'm Kathleen Borain. I serve as the Maryland Insurance Commissioner, and I am appointed by the governor.
And Louisiana is elected, I'm sorry.
Thank you all. For the newer members, we started this dialogue with the commissioners several years ago because we do have so many issues in common, and we strive to be on the same page, I think, about issues in state-based control of insurance. Last month, several of us from NCOIL went to D.C. for a fly-in, and we discussed numerous issues with our congressman. I think it was a very successful meeting, and I think most of the congressmen that I talked to were for state-based control of insurance. We talked about the reintroduction of the Prohibit Auto Insurance Discrimination Act, or the PAID Act, which seeks to prohibit auto insurers from using certain factors in underwriting such as education level and marital status. I'm just going to go through what we discussed, and then if you all have comments about any of these, just make yourself a little note and we'll come back to it. Excuse me. Excuse me. Also, we talked about preserving state regulation of health care with possibly some waivers or amendments to ERISA. I think there are some precedent for that. As I said yesterday, with other federal programs, we have waivers for Medicaid and Medicare and the Affordable Care Act. And I think certainly the Arkansas PBM law and the model law that our former president, Jason Rapert, championed here, that eventually went to the Supreme Court in the Rutledge decision, which said that that states do have the opportunity to regulate actors in industries that are adjacent to and have a cost impact on ERISA plans. So I think there is some penetration into that ERISA law, and we really are advocating for waivers to that program to allow more state control, particularly self-insured plans that only have employees in our state. That they would have to abide by all the state laws that we all fought so hard to protect consumers. The other one was enacting a long-term reauthorization of the National Flood Insurance Program. I live in I live on the Mississippi River, so I certainly have concerns about that. Overall, the flying was a real success. We also looked at the state-based regulation of a little bit of what we talked about yesterday, the Department of Labor's fiduciary rule that was overturned in 2016, but the feds are re-looking at. During our last dialogue in July, we spoke about your fly-in, which was held in April. And I guess, do you have any questions or comments in regard to those things that we talked about at our fly-in, or did you have different concerns at your fly-in?
I might just jump in, and thank you for that report and asking ours that was in April, as I recall. And some of the same things, the reauthorization of the flood, but something on the top of our agenda that we talked about at breakfast as well was Medicare Advantage. And we are really pushing hard to our delegation. We sent letters from the NEIC really to grant the states additional authority with Medicare Advantage. The problem that we see every year around this time and post-enrollment is we get the calls, we get the consumer complaints that they enrolled in a plan, turns out there's not the providers there that they thought they were, and we have no authority to do anything to help our own my state, Oklahoma consumers. And so we would like to have some more authority in that space. I chuckled when the response we got from them this summer was that they had noticed all their complaints were down, and my comment to that was, yeah, talk to me at open enrollment. It's middle of summertime. Nobody's complaining right now. We're not just prior to enrollment. We're not post-enrollment. So that's something big. And then I think you touched on it, Representative, but the PBM piece as well. There's been a lot of activity there at the federal level. That will tell you something that the states, numerous states, probably close to 40 now, have placed that under the insurance department, that compliance and enforcement and licensing. And we have our own case, actually PCMA versus Mulready, which is on appeal at the 10th Circuit. And that was a setback for us on that ERISA issue, a substantial setback versus the Rutledge case. So that's on appeal at the 10th Circuit. And if that falls through, that will probably end up at the Supreme Court as well. Representative, I might, one other thing is just, I think we're all on the same page there, but that we talked a lot about as well is the tri-agency, the STLD, short-term limited duration plans. You know, our letters went from the NAIC with that as well. For the most part, well, all we focused on is that's all well and good. This is a state decision. Each state should be able to decide that issue. It shouldn't come down from the federal side of things. So we'll see where that shakes out. But that was the position we took and talked a lot about that.
Sure, yeah, and we have a lot of concern about the federal position on those as well. The next thing we wanted to talk about was the NAIC Consumer Privacy Protection Model Law. The NAIC is working to amend some of its existing models, with the end result being a new NAIC Consumer Privacy Protection Model Law. The proposed amendments are on page 189 in your book. We understand that the draft model has been met with some significant concerns. Can you provide us with an update on what the next steps are? Also, why do you think the model's been met with so much concern? And even from the insurance industry?
Sure, I'm happy to respond. Let me first say that the H Committee, which is the parent committee that the Privacy Protection Working Group sits under, met yesterday, and we did two things relevant to that model law. The first thing that we did was we extended the time period through the end of 2024 for consideration and for drafting to occur. The second thing that we did was we received comments from industry about changing the charge slightly to allow more flexibility around what the final product will be. Will it truly be a complete rewrite, or will it be an update? We accepted those comments in order to provide for that additional flexibility. I'm going to start at the end instead of the beginning, because I think that it probably may be ultimately more germane to what some of your concerns are. And that is, we have pressed not a stop button, but a pause button, because there have been a lot of questions. There have been lots and lots of comments, lots and lots of meetings, fly-ins, to try to really work through the various issues related to privacy in general. So there's the big question and issue of privacy regulation in general. There's what's happening internationally. There's what's happening nationally. There are the existing state laws that exist. So from a big picture perspective, what are those issues? And then a second consideration is then, of all of those issues, what is really appropriate for a model law that regulates the insurance industry? And then the next piece is, and what does that mean then for our modernization of the model laws that were enacted a very long time ago, one right after the passage of Gramm-Leach-Bliley, the other right after the passage of HIPAA, one of which has been broadly adopted, the other of which has been adopted almost nowhere, right? So the objective here is to say, okay, the drafting group did a lot of work. They made a very good faith effort to put out a very broad model that has created a lot of controversy and a lot of comments. They have been working diligently through those comments, and the request of the H Committee now to that working group is that they pause. They take all of the comments that have been received to date, and they integrate them into a version 2.0. That version 2.0 is not going to be completed until the beginning of the year. When it is completed, the goal is not to expose it for further comment. The goal is to bring the commissioners together and have a discussion around where that 2.0 model currently sits. So with the benefit of insight and thought and comment from industry, with the benefit of insight, thought, and comment from this body and from other legislators, we now need to sit at the table as commissioners and really thrash this out. What is the right direction? Are we pleased? Do we think that 2.0 is in the right place, or do we need to pivot one place or another? That is a conversation that will be happening in the first quarter of 2024. And what I anticipate is that out of that commissioner and senior staff level conversations around the right approach and the right direction, and an effort to build true consensus among the members, we will at that point be ready to announce, I'm going to optimistically say at our spring national meeting, what that direction is going to look like. But what I can assure you is that, as you know, the NAIC tries to work from consensus, tries to work from the middle ground to accommodate the thoughts and the concerns and the needs of all of our states. And where we go from here will be reflective of that.
And members, if any legislators have comments or questions, certainly raise your hand and let Will know, and you're welcome to comment on any of these. Matt, you're recognized.
Thank you. Thank you, Madam Chair. Appreciate those comments, and I appreciate what the NAIC is doing on this. I like the idea of more of an update, because as we talked earlier, I think that, there's a lot of language there about mail and things that just, it's been the 90s, so it's time to update that stuff. I think one suggestion I guess I'd put out is, you mentioned the team you kind of have working around this, and at the same parallel to that, you're working there is the legislative bodies are working on data privacy as well. And I think we all share one common theme, and that is we don't really trust the federal government to take over all that data, especially around the, with insurance. So I guess I would ask that you just maybe keep us at the table, or this kind of dialogue works fantastic. But I also think in your planning is maybe reach out, especially to those, I know I ran the bill in Indiana, and other states have done that, is to, how is this going to parallel with what you're doing, or is it going to run into some conflict of what you're doing, so we can cut that off at the pass?
I think that's an excellent suggestion. I thank you for making it. And, what we can do is kind of coordinate about, once we kind of get to that 2.0 and we sort of have our initial discussions, how do we bring you into those discussions before we go out with something that's fully public? So thank you
Yeah,
for that
thank you.
offer.
I would appreciate that. Appreciate that real a lot.
The other thing that we addressed in a general session yesterday was the artificial intelligence as it's related to the insurance industry. And as you know, we had a comment letter because we have concerns about some non-statutory terms in your bulletin. So can you comment on your bulletin and steps in further developing that, and maybe removing that non-statutory language?
Oh, absolutely. So let me talk a little bit about the process, if that's okay first, for those who didn't have the benefit of that yesterday. So we all know that artificial intelligence is playing a huge role in how everybody does business these days, and that includes insurance companies. And there's a lot to be gained, a lot of efficiency, a lot of consumer benefit to be gained, but there's also the potential for consumer harm. And so, like any other methodology, like any other tool, it has to be used within guidelines. The legislatures, all of our legislatures have passed significant legislation over the years that regulates the insurance industry, that regulates what it does and how it does it, and what it's allowed to consider and what it's not allowed to consider. So throughout the entire underwriting, the premium calculation or underwriting and rating processes, through the claims processes, there is substantial legislation on all of our books that guide that process. The NAIC made the determination that we do need to have a U.S. regulatory framework for the use of artificial intelligence by the insurance industry. We spent about a 4 or 5 month intensive period of providing foundational education to all of our commissioners at the commissioner level to make sure that we had a common ground of understanding, vocabulary. We brought in experts, we brought in professors, we brought in folks that do this on a day-to-day basis to provide that foundational education. And then coming out of that, really understanding the basics and understanding sort of what the pros are, what the concerns are, what drives those risks. We then met in a very lengthy session in New Hampshire at the end of 2022 and had roundtables where we sat together and said, okay, what's the deal? So the questions that each group was asked were, do we want to make a statement? When? What should be its form? Should it be prescriptive or principles-based? And how should it address third-party vendors? And what came out of that was an amazing level of consistency and consensus. Literally, every working group, very few people didn't have exactly the same views. So 1, we needed to speak. 2, we needed to do it now. 3, we decided that the most appropriate approach was a regulatory bulletin that provided guidance and expectations for how to use these tools given the legislative frameworks that already exist and already govern and set standards for industry behavior. We had robust discussion about whether it was appropriate to do a model law or a model regulation at this point. And the decision to do the model bulletin was driven by, first of all, we felt we had the statutory underpinnings to be able to provide that guidance, number 1. And number 2, we felt that in terms of time and speed, that the bulletin was the most efficient way to go. That does not preclude us from, in the future, if it makes sense, to go to another effort to look at model laws or model regulations. But in that time, in that moment, it made the most sense to us to move with a bulletin. So that's what we did. And then we also decided that it would be principles-based. It would flow from the principles that were published and voted on in 2020, and that it would focus on primarily governance and risk management. And that with third parties, we were not going to try to regulate third parties through this process, but we would hold licensees responsible for the data that they use and the models that they use from third parties. Our drafting efforts, which have been, again, very highly collaborative, very broad participation across all the states, over 20 states involved in the drafting process, resulted in a draft that was circulated in July. We accepted comments. We came back out again with a new draft in October. I think that it is, and we're still looking at the definitions, right? So we appreciate the comments with respect to some definitions. We purposefully avoided wording and certain definitions that aren't defined in statute. And frankly, we avoided defining terms like unfair discrimination, recognizing that some states have specifically adopted definitions in statute, other states have, their courts have done that. Where we chose to include defined terms, for us, were along the lines of what you would expect a department to do, to say if these are less legal terminology. So for example, you'll see the use of the term an adverse consumer consequence, right? So we're trying to focus on, in this bulletin, what we are most concerned about are AI systems that have the potential to create an adverse consumer consequence. And so those are words that we're just trying to define. They're not in statute anywhere, but that's because, statutes are really broad. And here we're saying, okay, for this bulletin, we're just focused on this activity. We talk about things like proportionality. So our bulletin says to companies, we know that a great big huge global company, multinational, that writes, $100 billion worth of business a year is really different than one of your monoline interest, one state workers' comp carrier that writes $100 million in premium a year, right? So their staffing, their needs, what they do are going to be really different. So part of what the bulletin does is it presents the idea of proportionality, right? And so not just in terms of the robustness, but also in terms of, telling companies what we want you to do, want you to focus on, and your processes should be commensurate with the risk of harm to consumers, right? So we use that term, risk of consumer harm, that if you've got something that's really going to hurt a consumer, like pricing decisions, you need to be more robust, right, than maybe thinking about, what your chat box says. So those are the kinds of things that are words that we're using, that we are defining. If there are other specific terms that are still left in the bulletin, I know we haven't received your next comment letter. We are happy to consider those thoughts, but the goal has not really been to try to override statutes. It's tried to focus on more practical terminology that you wouldn't normally see defined in statute in any event.
Representative Carter, you had a question or comment?
Yes, thank you, Madam President. I would like to know, with artificial intelligence, have you considered its impact on rate making and possible discriminatory factors with rate making?
Absolutely. I mean, that is a huge driver of, this exercise. Yeah, I mean, I think it's one of the main drivers. We have to be careful to make sure that we don't limit it to that, because, claims administration is a huge issue as well. Quote unquote fraud detection is a huge issue as well, and whose claims are considered fraudulent, and frankly, marketing practices. So who's worthy of insurance in the first place, and then the underwriting standards. So you're absolutely correct that that is a main driver. We do have very robust systems in place in the world of insurance that deal with the standards around discrimination. I refer to it as discrimination with a little d and discrimination with a big D. So discrimination with a little d is this idea that if you're going to charge Mary a rate that's different than Joe, it has to be based on something that's different between the two of them that relates to their risk, right? So that's the term of unfair discrimination, right, which is a throwback term, right, little d. And then there's big D, right, which is, are your practices such that they are discriminating against protected classes, most of which are identified in statute. And the concern that exists is that sometimes it is difficult to be able to assess what those impacts and outcomes are. It is not impossible. Washington, D.C. is embarked upon an analytical exercise in a market conduct exam to look at this attribute in the context of auto rating. Maryland just issued orders relating to practices that we were very concerned about in terms of the potential for redlining in this day and age. So I can assure you that a large driver of what the work that the NAIC does, the NAIC has a group within its C committee and its casualty and actuarial task force that looks at large predictive models, particularly for large companies. And the actuaries that run that group, right? You know Dorothy? Yeah, so you know Dorothy, so I probably don't need to say anything else. You're welcome.
Senator Walker. You're
Thank
recognized.
you, Madam Chair. So I've been in the insurance business long enough to remember the sort of controversy surrounding financial responsibility as part of an underwriting process, and the carriers were able to demonstrate that there was an actuarial basis to use that, and so it's widely accepted. My concern on this AI stuff for underwriting is it seems to be a lot of black box proprietary factors going into that, and there'll be tension, I think, between the Georgia Insurance Commissioner and carriers with regard to transparency on that, and I wonder if your bulletin or you all discussed transparency and what factors go into that decision. I've got a new homeowner carrier that all we do is put in the address, the name, and the date of birth of the prospect, and they provide a homeowner rate, but they decline a huge percentage of our submissions, and we have no idea why, and they don't tell you why.
So the bulletin doesn't do deep dives into transparency. This bulletin is focused very much on the development of and use of AI from the standpoint of governance and risk management. It repeats the principles that companies need to move toward transparency, but what it doesn't do, and please understand that this is not our last word. This is an incremental process. And what you're talking about, which is what are the directives that should be placed on insurers in terms of what is the level of detail that they should be providing to consumers beyond letting them know that there is an AI system in play. What is the level of detail that should be available to consumers and to their representatives as brokers in terms of what's driving their particular denial, et cetera. So that work is still being discussed at the NAIC. That is a next step. The bulletin does have a statement in it that reiterates what was in our principles about the need to have explainability and transparency, but it does not go into specifics with respect to that. And that is an area where I think states are still evolving in terms of what they think the right approach is for their individual state. I hope that gives you a sense of where we are with that.
Madam Chair, can I have a follow-up?
Sure.
So I guess my concern, first of all, I always like having a unfair advantage anytime I can. But my concern is for the consumer and really for the insurance market, I guess, in general in Georgia, is if you've got a carrier that has built a better mousetrap, so to speak, and comes in and more or less takes the cream of the crop or cherry picks, but isn't sharing in the wider population of risk, and then the other carriers are going to be adversely, adversely impacted by that. And just as a regulator, insurance commissioner, is that a concern you would share possibly?
It's always a concern, absolutely. So, but that's why we exist, right? So I do have optics into every carrier's underwriting standards. I do have optics into all of their rating plans and all of their rating factors, because that's what we do. We receive their rating factors. We review their rating factors. Some states are prior approval. Maryland is not. But we do evaluate all of those rating standards. And what happens with us is that when we have brokers like yourself or consumers that are saying, what's going on here, we do investigate that. I'm in the middle of a large market conduct exam exactly on that issue. So we are concerned. What the typical concern is that, making sure that those underwriting standards meet the statutory guidelines, that they are not unfairly discriminatory, and making sure that carriers write everything they have a rate for, and they don't say, well, I have really broad underwriting standards and a really great rates, but I'm going to cherry pick what I want out of that because I'm not going to write everybody that qualifies. So you are absolutely correct in that, and having those concerns, and that those are the concerns of the department, right? We use the laws that already exist and the tools that already exist to address those considerations, I would say literally on a daily basis.
Senator Walker, Representative Lehman has had a model legislation about this transparency at NCOIL for a while, so I think he's dying to make a comment.
No, you hit the same concern I had when we did the transparency model. which we then passed in Indiana last session, House Bill 1329, I can get you the language, but it basically creates that disclosure to the consumer from the carrier as to what were the largest factors going into that rate affected. So I can give you that information offline.
Okay, I think in the interest of time, we probably ought to move on. But I will comment, the bias, non-statutory word, was one of our major concerns in the bulletin. Okay, we talked about a little bit this at the breakfast, and I know there's a little controversy about it yesterday, but the Securities Valuation Office and the SVO and their retroactive look at valuation, and can you just sort of comment on your process and why the SVO exists and when you decide to retroactively look at the rating, sort of all the things we talked about at breakfast, maybe?
Yes, ma'am. I'm Jim Donlin from Louisiana, and I've been asked to speak to this. As Commissioner Bahrain has spoken at length about here this morning, the NAIC is strongly committed to the privacy protection model law but not doing
SUV.
SUV.
Security.
SVO. Got it. And all right. Okay.
I stole his copy of his notes, so I'm sorry.
Thank you, ma'am. Let me just hit a few points that I think are relevant to that discussion. Relying on credit rating agencies is an efficient way to review insurer investments, not company solvency. But increasingly, we regulators have become concerned by the quality of ratings for certain classes or certain tranches of investments and have noted significant discrepancies between rating agencies for the same investment. Since capital charges are directly linked to these ratings, there's a troubling potential for rating shopping by some insurers to avoid having to hold more capital. I myself, in my state of Louisiana, have twice engaged with the SVO on behalf of investments that were on the books for top of the line, very old, over 100-year-old life insurer in one case and another in the P&C area that had downgrades on part of their investments and asked me to intercede, which I did with the SVO, and worked it out. Frankly, I don't know to what end, whether they succeeded or not. But that is the only experience I've had in 18 years with the SVO, and I consider it to have been positive and their role to be important. That rate shopping issue, I think, is not really relevant to the discussion that we're having, but I can understand why the issue has been put forth by some of you, and we are committed to working in collaboration with you to resolve those issues. You'll recall during the 2007-2008 financial crisis that blind reliance by regulators on credit ratings in part contributed to overlooking a growing subprime mortgage crisis, not in the insurance arena, but in the banking arena. And while Dodd-Frank required many federal regulators to take steps to reduce their reliance on such ratings, no such holistic changes have been made in state insurance regulation. In discussion this morning at breakfast, the concern that has been expressed by industry for the fees being charged for the services at the SVO, specifically for appeal processes that may be necessitated, we are taking back to NAIC, and we'll discuss within our internal folks the need for, number one, if they are being charged additional fees for appeals, which I doubt based on my experience, but if they are, the need for that, which I doubt also. So with those things said, know that as a result of the SVO drafted of the concerns I mentioned earlier, a proposal that would grant it a limited amount of discretion to review and challenge for NAIC solvency regulatory purposes only, rating agent assessments of investment risk. And the proposal was exposed for public comment in May with a July deadline, which is approaching. With the SVO's proposal, it's also important to note that a state insurance regulator, just like the SVO, would be able to initiate a review of a rating designation under our proposal. Madam Chair, with those comments, I'd be happy to try to answer any questions anyone might have.
Senator Thies, you're recognized.
Thank you very much. I would respectfully like to ask that you reconsider. My issue is not just with the fees associated with it, but the way that the oversight would have to work. So if an industry, if a company that was going to be invested in got downgraded, their ability to go back to their rating company and say, here's the reason why we think that's incorrect, that's significant, and they have an ability then to have a back and forth. That makes sense. But if their choice is to go to the regulator who regulates them, there's no open discussion there. So that is a huge problem for me. It's like the fox watching the hen house, and please forgive the reference, but there's no freedom of communication back and forth. So that's a major issue for me, as well as the fees. You are already effectively regulating, and I understand the concerns, but the references that you're listing right now go back, 15 years? And this is a quantifiable measurement. You can look at the people who are currently doing the ratings, and you can see whether or not they're rating beyond the solvency of the industry that they're looking at, or the business that they're looking at. So I want to push back on where it is you're heading for this, and I would hope that the other legislators here would do the same.
Yes.
Can I just get a point of clarification? Are you referring to the credit rating of the company or the credit rating of the investments?
I am concerned generally about the SVO oversight altogether and how it interacts with the company.
Thank you, because this particular exercise that we've been addressing, and I'll certainly take those comments back, have been very much focused on the rating of individual investments and types of investments, which obviously ultimately can have an impact on the overall credit rating of the company itself. But the primary exercise is around what is the appropriate charge ultimately, is what's the charge on a particular investment, and how does the NAIC determine that for purposes of what is allowed to be considered in statutory accounting as available capital, so that when consumers make claims, the money's there to pay them.
I absolutely agree, please, with your permission, agree that we need to be utterly concerned about the claims and whether or not the money is there to pay them. And we can get into all kinds of other discussions about what you consider to be valid investments and what the reasoning is behind the strength of an investment, which is a whole nother discussion we're going to have later, I think. But I just want caution because of the lack of ability for a defense in what the outcome is of the ratings, or what the determination is of the ratings, and the complexity. I mean, the people that we had speak were absolute experts on a very minute portion of review of value, and our SVOs will not have that level of complexity.
No, I appreciate that, and in my years at DLA Piper, I certainly worked on CLOs and CDOs and the investment part of things. So I do very much appreciate your comments, and I do think that just for awareness, that there is a new draft that is coming out that is specifically targeted at looking at that appeal and input process. So I think we'll have the opportunity to review those new sections and get your feedback on those once they're out there.
Senator Hackett, you had a question?
You got to hold on, okay. Thank you. You know, and I was the one that actually defended you yesterday, but after the fact, you know, a number of people criticized, and right, so I didn't change my views. I was an investment advisor. I went through 07 and 08, and I saw the mistakes and was not happy with New York and, you know, and a lot of things. You know, if I could see it, a lot of other people could see it. So I don't mind having another set of eyes. The problem that came on this scenario is a lot of these people thought you were overstepping your bounds, not just with the excessive fees, but were you trying to, and you defended it really well, but you heard it yesterday. Were they trying to actually come in and be a rating agency in yourself? You heard it yourself, and so that's when you go back and talk to them. You know, I don't mind having another set of eyes involved, et cetera, but we need to have the expertise, which I think there is good expertise with the Department of Insurance. But that's the scenario. Is some of the people, and I wish Tom was here. Tom could speak for himself. But they just thought maybe you overstepped your bounds. You've gone a little too far in overreaction. I'm curious to see what you say about that.
Senator, if I may ask, you know, unfortunately in my home state of Louisiana, we've had more than our share of insolvencies over the years. We rely on the model laws that have been in place since the 90s, which were part of the accreditation process that's core to how we operate on a national basis, state by state. And the model laws are focused on individual rules relative to individual investments, not the rating of the company. We're not, to my knowledge, and I stand to be corrected, Commissioner Bahrain is much more knowledgeable than I in the solvency area, and unfortunately, Superintendent Dwyer can't be with us. She's our chair today. She had to leave this morning. But, and we'll certainly take your concerns back and consider the fee structure and the appeal process and the transparency of the whole process from what we learned here with you yesterday and today. But we, to my knowledge, and I defer to my colleagues, we don't want to compete with AM Best, Demotech, and the other company rating agencies. And what I've heard in the hallway here is that Demotech, for one, is not concerned about us encroaching on what they do. That's not their concern. And frankly, it shouldn't be, because we don't want that. We don't want to do that. So your points are well taken. We'll take them back, but it's really statutory requirements for the evaluation and the acceptance of different categories of investments that companies put on their books for their ability to pay their claims. And we are evaluating those investment vehicles on an individual basis, not on a company-wide basis.
And I might just add, Madam Chair, if I may, that we've received 17 comments on this, which includes 45 pages, and that will be part of the review here in, 10 days, 2 weeks at our national meeting in Orlando.
Yeah, the only point I want to make, Senator, or Commissioner, is I understand, you know, the insolvencies you've had, but there are other factors that led to the insolvencies, and you know that, and I know that, and they're factors that people thought you would never face on type of claims. So it was more than just the investments that caused the insolvency, because in Ohio, we don't have the problem that you had down there. And I ask people, the question is, how much do you think, you know, our fund, the fund puts in to run the Department of Insurance? And what the answer is, I know what it is, zero. Everything is paid for by the private industry in premium tax dollars. So there is not one dime put in by the state of Ohio, because that's just the way the system runs in Ohio.
And it runs the same way in my state.
It's not just the investments that cause the insolvency in Florida and that, and you agree.
Absolutely.
Representative Mickle, you have a question.
Thank you, Madam Chair. So My question is more of kind of maybe a point. The appeals that get put forth are putting the companies instantly on defense. So it's something that they have to argue against, and as the regulator, you're the one that's already has the upper hand to the insurance companies. So maybe just taking that into consideration, and also under consideration that in every state, these appeals processes aren't always on the up and up. And so in specific states, you might have different issues with the appeals process. And beyond that, we're also looking at, these things are documents that are being put in the company's filings, and the rating companies are going to be looking at all of that. So maybe you're not giving them a poor rating or have anything to do with the rating, and I understand that, but this does affect the company and their bottom line when you write these things down and put it in permanent record. So just a thought.
No question about it, and I, for one, as a legislator, was very supportive of imposing, and it's in place, and it's been part of my burden in the 18 years I've been now commissioner, when I took action that companies challenged. We have now, outside of my authority, a division of administrative law that oversees DEQ and myself and state revenue department. All of us regulators and state agencies are subject to that expedited oversight by in Louisiana, not judicial, not court system, division of administrative law. I supported that. I continue to support it, even though I've had my issues with it over the years. There's no such avenue available to us on a state-by-state basis for oversight of regulators. The courts, we don't want to go there, and I don't think the companies want to go there. So to the extent that we can, under our state, deferring to the domiciliary state for regulation of solvency, as our accreditation system has mandated, to the extent that we can make it transparent, more user-friendly, less expensive, like you have brought to our attention here in these 2 days, and I think my colleagues are all in support of doing that. This has been completely off of my radar until now, when I came to Columbus. I had that one investment product at a large international life insurance company, and it got resolved without me even knowing how the resolution ended up ending up to the satisfactory of the company or not. And I had another from when I was president from a different state that also got resolved without me knowing what the outcome was. So it hasn't been brought to my attention in 18 years as an issue until now. But certainly, these are legitimate questions. Cost, transparency, appeal process, et cetera. And as Commissioner Borrain and Commissioner Mulready have already said, we'll take your message back and address it at the NAIC level. Thank you.
Okay, I think we'll move on to the next topic. The discussion of the NAIC data call relating to property insurance market. We saw the NAIC's announcement of its plan to issue a nationwide data call to help state insurance regulators better understand property markets, coverages, and protection gaps in light of increasing climate risk, reinsurance costs, and inflationary pressures. We're also aware of the recent announcement by the Federal Insurance Office of its plan to also issue a similar data call. Starting on page 191 in your books, in your binders, you can see both the NAIC and the FIO's announcement of their recent data calls. The description of FIO's data call does seem very similar to the NAIC data call, and it's our understanding that there was communication between the two of you regarding whether or not the FIO data call would be duplicative. Can you describe to us what those conversations were like and how the NAIC views FIO's data call I'd also like to note that with this data call from FIO and with other federal actions such as the Department of Labor's fiduciary rule and, as we talked about earlier, the short-term limited duration rules, there do seem to be significant threats from the federal government to intrude on the state-based system of insurance regulation. It might be worth considering our respective organizations working together on some sort of joint comment letter to push back on this activity altogether, since we do represent the legislative and the regulatory authority for state-based systems.
That was a lot.
I just read what Will told me to.
But quick question for Will and for Tom. If I develop carpal tunnel from holding this button down, is that covering my workers' comp or your liability? Which is it? Sorry. If I can, though, I'd like to talk a little bit and then get back on track on what's happening with homeowners coverage. Every single one of you at this table, every legislator, is or will receive phone calls from your constituents about rate increases on their homeowners policy. I can guarantee it. I've received numerous of them, so let me just talk a little bit about that. And I'm from Oklahoma. We are, like I like to say, we're a weather state. And so that's a bad thing, but and that impacts us even more so. But it is happening across the country. And just quickly, just like I tell my legislators at home, here's what's happening. And that is, number one, we have catastrophic storms. We are having, the frequency and severity is greatly increased. So we're just seeing more and more of these catastrophic storms. In April in Oklahoma, we had a tornado. That's probably approaching $1 billion claim. We had one public school, a high school, that claim alone is $30 million for a public high school in Shawnee, Oklahoma. So we're seeing more and more of those, severity and frequency. We also have an issue in the reinsurance world, as you stated. And Reinsurance Association folks are here. They can talk to you about the $200 billion of capital that left the reinsurance market just due to changing interest rates and other potential investments and other things happening in our economy. Well, that does nothing but drive up costs for the reinsurance. And the third is just inflation, the inflationary pressures that are happening. I experienced this personally. Just this last week, we had our own roof claim. My wife was going to send off that final check, and she pulled out of her file a bill or a proposal, and it was for $20,000 a number. And she said, "Is this what I send off for the roof?" And I said, no, that's the proposal from 1.5 years ago, almost to the day, a year and a half ago. The same roofer who replaced our roof a year and a half later, it was $26,000. It's a 30% increase in a 1.5 year period just due to inflationary trends. So that's what we're seeing. And now I'll get back on track. Alan McLean, Chair of C, is the Arkansas Commissioner. He was unable to be here because he too was called to testify in front of a committee at his legislature. I know he has his deputy, Russ Galbraith, here. He's probably the little guy in the back of the room. But he wanted me to apologize that they couldn't be here. But we are in the midst of doing a data call to develop that data, trying to identify coverage and protection gaps. Also focused a lot on availability and affordability. I think it's important to note that, like within Oklahoma, we have certain storms in this, but I specifically mentioned Shawnee. I mean, it can have a very concentrated differentials within a state, within a geographic area. So we'll be focusing on that and really just helping our regulators better understand the marketplace with that. Now, we focus on solvency, and we know what's happening with that and other filings, but the availability and affordability, it's a little bit tougher for us to keep our finger on the pulse. And so that's really what this effort is about, so we can better understand that. And we believe the state insurance departments are best suited for that. You mentioned FIO and their data call. I would argue that there was engagement with us. We received a letter requesting that we provide this data to them. It was a very unreasonable time. It could not be met. I can tell you that our state, we sent back a letter saying, we are happy to work on this. Number one, we don't collect that data at that level at this time. And we could get it to you, but we can't do it in 30 days. And I forget what the exact time frame, but it was not a reasonable time frame. So I don't believe there was reasonable engagement at all with FIO, and we have pushed back on that. And I think you are right to identify it as a significant threat of federal overreach. And so we are doing our own. We are going to gather, analyze, and then utilize that data for each unique market. I think what we envision is more of an ongoing collection of data as opposed to a one-time thing, but it would be more of an ongoing thing that we could continue to update and give each of us a better insight into our own markets. So that would be more of a long-term. But what we will be collecting is the down to zip code level data, premiums, policies, claims, losses, limits, deductibles, non-renewals, and coverage types. And that data request format has not been finalized. They are working on that, and hopefully we'll finalize that here in about 2 weeks at our national meeting. So,
I have a
and
question.
your
Is
idea of
the-
a joint letter, I can't speak for NEIC, but speaking for myself, I would highly encourage that. I think that adding that weight of the two organizations, pushing back on that is very helpful.
Is the primary function of the Federal Insurance Office to collect data? Is that their primary what would you say is their primary function?
I think that's a great question. What is your primary function? Why do you exist? I think the original idea of FIO was more on the international, representing the United States maybe at a federal level, but I think there are a lot of people that question what is that role, and I think there is movement to sort of justify that position of that role, like what we're seeing here with this data call.
Any other questions? Then I think we'll move on to an always interesting topic, cannabis. I know Ohio just passed their recreational marijuana law, but particularly cannabis as it relates to insurance. NAIC recently issued a white paper to serve as a regulatory guide for understanding the market for cannabis insurance. It's obviously very topical. Can you provide a brief summary of the white paper findings and what we should be aware of as legislators?
Thank you, Madam President. Yeah, I get the fun topic of the day. You know, it's for me in Kentucky, this is a quickly learning experience because we just recently passed our first medical marijuana. And, you know, I didn't know if it was ever going to happen, Sarge, but anyway, it did. So we have been scrambling to find, you know, what was the insurance impact. I didn't really think about it until I got a desperate call from our agency that will be overseeing this, you know, product. And we had a very thorough discussion on what their insurance needs are going to be, because in the legislation there is a requirement for liability insurance. So that takes me on this journey of learning more about cannabis, although Glenn Mulready knows a whole lot more about marijuana than I ever did, okay? I told him I was going to say that. But anyway, but seriously, in 2019, the first paper came out, and it was just really looking at some of the major obstacles and where we were at that time. And what a difference, you know, 4 years makes, because we're now, I think it's up to 38 states that allow medicinal marijuana, plus 3 territories. And then there's 24 states that allow the recreational. So the insurance aspect of it, when my agency contacted me, they were asking Commissioner Clark, we have to have liability insurance from that seed to the dispensary aspect of it. And so we're looking at, and then there's different components. In Kentucky, it's greenhouse only growing, so that makes a little bit of difference. But the liability coverage of what is needed and the limits. Okay, so we did our homework, did a recommendations to them. Then it becomes the availability. You know, are there insurance companies out there that are going to write this coverage? And right now, it's primarily in the not admitted surplus lines market. You know, we did in Kentucky, just in the last 6 weeks, have a company to apply that is going to be looking about limited insurance coverage. They're not going to do the seed to the dispensary, but they're, you know, a little segment. But it is a issue out there that's going to be, you know, is challenging for all of it. I can't blame the insurance companies for not wanting to step up. You know, you have all types of interstate laws you have? Are they going to be accused of criminalization, processes? So really what we need to happen, most of you all have heard about the SAFER law that is in Congress that protects and allows for federal banking institutions to deal with this. However, there is another piece of legislation with Senator Menendez in Congress that's called the CLAIM. And it's the Clarifying Law Around Insurance of Marijuana Act, CLAIM Act. And what that act is going to do is going to allow insurance companies to provide that coverage for any aspect of the operation in a state that has legalized marijuana without having any type of penalties. And it can be done on a state-by-state basis. California has passed legislation to protect the industry. But, the easiest would be to have a national law on it. So anyway, it's something we're all facing, and, there's still concerns, but again, federal action would be the swiftest remedy. And if you've got any questions, particularly on marijuana, ask Glenn Mulready.
Now, Glenn, why do you know so much about marijuana? I'm curious.
Thank you for giving me a minute. For the Oklahoma legislators in the room, I think she's referencing that we have had that in place for 5 years as opposed to me personally. I will just add a couple of things. We did, I think it was 2018 that we passed through initiative petition. It did not come through the legislature, and that caused a lot of problems because it wasn't well written. Fees were set extremely low, and it has caused a lot of problems. I know many of you have heard this week a lot about Oklahoma and the MMA. However, I'll talk to you about the Oklahoma Medical Marijuana Authority, the Oklahoma MMA. They have had their hands full. We have over 2,500 dispensaries, over 5,000 growers. It has really become a big issue. This past year in our legislature, I think it was SB 913, they passed a requirement for a surety bond, a $50,000 surety bond. So that's been the newest development in this industry. We have had meetings, some conversations with some captives to come up with additional solutions outside of surplus lines, but there's some potential captive opportunities there for that industry as well. So that's about all. Though I will say, also, I think it was a week ago today, our Attorney General's Organized Crime Unit came in and seized 72,000 pounds of illegal marijuana in the state of Oklahoma. And they gathered that all and weighed that and burned it. So
I told you he knew more than I did on.
Any other questions for the committee? Representative Hunter, you recognize Assemblywoman Hunter.
Thank you. I just have a quick question. Consistent with the Safe Banking Act, and you were making mention about a similar piece of legislation, would NAIC consider taking a proactive stance and petitioning the federal government to declassify marijuana, to reduce it from the Schedule I? It seems, as we've been having this conversation relative to inflation, the market will not be able to sustain, especially with the servicers, the providers keep asking for rate increases. That's what's happening in New York. And we see people who are uninsured, underinsured, people driving without insurance just because they are getting tapped with increases. And with cannabis, we have a large illicit market because the way we did it was just wrong and we messed it up really bad. But is there a way that NAIC would take a strong stance on declassification? Because it seems to me if we did declassify it, that would open up banking for this emerging business that they literally are keeping tens of thousands of $millions in cash in people's homes because they can't bank it. And this is real, this is actually happening, and would loosen up and help with the insurance market as well, ensuring it just like any other, I guess, agricultural product.
I don't know how much influence we would have on that aspect of it because, of course, marijuana goes back to Richard Nixon days with the Controlled Substance Act that was passed at that point. I think with the popularity, I think I saw some recent polls where like 80% of Americans were in favor of medicinal cannabis. and it was dropped off a little bit, I think to 60%. The quickest way, rather than us getting outside our guardrails and outside our lane, I think is for the Claim Act and the Safer Act to pass. And that might answer the question. I don't know. Getting into, the drug, I'm afraid if they open up that drug act, we can get into all kinds of questions and it would be a much slower. So I think the claim and the safer are the fastest way to get there.
I'll jump in just quickly, Pam. I think we'll bring that back. But I think that might be a little bit of a step outside of our lane for many of our members to get behind addressing the banking issue as opposed to insurance. So just a thought.
Okay, seeing no further questions, is there any other business? Seeing none, we're adjourned.